Hi Motheo, I'm Simpiwe and I've just started my first job as a junior developer. I want to buy my first car and help my mom finish our family home, but everywhere I turn, I'm being offered credit, store cards, personal loans. It feels normal, but also risky. How do I know what's safe and what's a debt trap?
Welcome to Everything Counts, the podcast where we make money make sense. Today's episode is about something that hits close to home for many young professionals: debt. We're talking about the difference between building wealth and borrowing your way into financial traps. I'm your host, Motheo Khoaripe, and joining me today are two people who know this world inside out. First off, Keshnie, lending product owner at Investec, and Lehlogonolo Ramushu, a credit risk consultant at Investec. Welcome to the both of you. Thank you for joining us on Everything Counts. We're talking about something I've also gone through as well. As you start work, you get offers from different points. So it's something that we all experience and we can all make mistakes. So it's a conversation that I'd like us to expand on, to try and help those young professionals to make far better decisions when it comes to deciding on how they manage their money. So let's start with the big picture, right? Why are young professionals getting into trouble with credit so early in their careers?
So I think we were all young once, and it's very difficult transitioning from having little to no responsibility to the world of adulting, to having budgets that you track monthly, differentiating between necessities and luxuries. There's also this added dimension of peer pressure and social pressure to live up to a certain lifestyle. And there's also a narrative that says if you want access to credit, you need to have a credit profile.
Yeah.
And I think therein lies a bit of a caution, because you don't need to go guns blazing into getting a profile. It's just to trade cautiously.
Lehlogonolo, as a young professional yourself, I'm sure this particular topic you can relate to because you've gone into the working world now and you understand from a credit risk perspective, things can go wrong. So what are those challenges that young professionals are facing when it comes to managing their credit and their debt?
I fully relate. There's a lot of offers everywhere, be it for increased credit limits, personal loans, store cards, even for cars. So you often hear of people saying you need to take out a store card in order for you to build a credit profile, because without that, then you don't get access to other credit products. What people don't really talk about is the impact that this has on future credit and your overall credit profile. And the truth is, in the world we're living in currently, there's easy access to credit. And it's easy to be in a position where you think, what harm can this do? And actually take it out without having a need for one, and without understanding the implications that it will have on your profile and your cash flow position on a monthly basis. So it's important to understand your financial needs and take out what you actually do need, and not just feed into the lifestyle pressure or the overall peer pressure. Just the other day, I also had an in-app notification to say you can take out a higher limit, and it would be very easy, just activate it on the app. And it's very convenient, right? But you have to ask yourself the question, do I really need this thing? Because I've been surviving without it. And now that I've seen this pop up, there's suddenly a need for me to take it out. So I think the most important thing is to understand your financial needs and ask yourself, do I need this thing?
When you start working, right, you get all these approaches to say you earn money now, you're an adult, you can handle your finances. So why don't you take on a bit of more debt? So let's talk about the marketing of it, whether it's traditional media to TV, radio, or even of late, we use our phones more online, where you get offered all these great deals. And because you're earning a salary, you think, I can just pay this off. But if you're offering me that much money, I can get my dream car first off. Those are the tough times that you need to deal with when it comes to the marketing. So how do you manage your money behavior then?
I think it's really important that the individual takes responsibility for their finances. I mean, like you've described and Nolo's described, there is ease of credit, especially unsecured loans. So when we talk unsecured loans, we're talking your check account with an overdraft, your credit card, your personal loans. Those things you can access quickly and efficiently. But the onus is on the individual to make sure they're not taking on more debt than they can service. So it's important that the individual takes responsibility for their finances and that they budget and make sure they have that money available to service the loans. And it is very tempting to try and take on the loan. But let's be honest, 5 loans later, and then you're stuck for cash because you've got wear and tear coming up, you've got an emergency in terms of your home, or you just have an unforeseen expense. Maybe it's even books if you're still studying that you didn't factor in.
Given the times that we're living in, especially with social media playing a big part in our lives, especially as young professionals, that's where the danger is, right? There's credit offers everywhere. So you could be on Instagram and you'll come across an advert that says, do you want to take out a personal loan? And it's as easy as 1, 2, 3. And sometimes in the wording, they use smart wording, right? So they'll say something like, if you apply for this personal loan, it's easy and risk-free, which could be referring to the actual process and not necessarily the loan. But now, as somebody just reading that as a young person, some who don't even have a finance background, that can be very appealing. So we must just learn to read through the actual fine print, the terms and conditions, understand what you're getting yourself into, because at the end of the day, you know your finances, responsibilities, and affordability more than anybody else. And small loans do accumulate over time. You take one today and it puts you in a tight position next month, and then it becomes easy to take out another one to settle the other one. And before you know it, it can become a cycle.
So as a young professional, how do you know when you're taking on too much debt? Because they tell you that, look, you need one, so you at least have a profile, a credit profile, and wherever you're going, whether you're getting your first little car or you want to pay off your student loans, take out one loan.
I think the easiest way is to look at what surplus you're left with at the end of every month. If you have little to no surplus, you have taken on too much. And then you need to reassess where's your necessities, where can you cut back on some of your luxuries. If you haven't created buffers for yourself, if you have a car and if you haven't factored in wear and tear, which insurance generally doesn't cover, then you're bordering on being over indebted. And I think also if you give into the peer pressure around maintaining a certain lifestyle, you are not making conscious financial decisions. You're not saving and putting away money for rainy days. You're not having these financial goals that you're trying to achieve.
So it's important then, as the person loaning you goes through their own checks about your credit profile, that you go through your own as a person borrowing the money, because you need to see whether it's going to balance out at the end of the month for you.
Absolutely. And I think the most important thing is to have enough money to live off. I mean, we know that the cost of living is really high, food, petrol, all of that's going up all the time. So if you haven't left enough room to live, you can quickly find yourself in over your head.
Lehlogonolo, is very easy as somebody who's a student or somebody who's getting into the working world to be offered this type of money and you feel secure because you now earn a salary. But how important is it then to check your own behavior and make sure that you safeguard yourself?
We understand the need, especially in this space, the young professional space, that when people start working, there's a lot of things that need to happen. Some people have to relocate and some have to buy furniture, and not everybody has access to the liquidity readily available. So we do understand the need for debt, sometimes unsecured debt. And I do think that as young professionals, the problem is we tend to forget that this type of debt comes with high interest rates. And as a result of that, it becomes very expensive for you to actually repay it at a later stage. So it all comes back to understanding your finances as an individual and getting to a point where you understand that if you take on more than what you can safely manage, then you are at a point where you're in a danger zone, right? So you need to understand your own finances. And if you do take out the loans, you need to then pay them timelessly, because if you don't, that has a long-term impact.
Keshnie, I want to take you back to the emotional lending part, where you start earning a salary and there's a lot of expectations from even your own family, and your friends expect you to get the car you've always been talking about, and you feel a little bit of pressure to get into maybe the higher numbers of the loans in order to afford the things that you can't really yet with your beginner's salary.
So like buying the fancy car when you might not be ready.
Yes.
Yeah, I think that is a big caution, because when you're starting out, there's an element of, to Nolo's point, if you haven't got a financial background, you're still learning about how loans work, how you pay off interest, the total loan amount that you're paying for. So there's an element of financial literacy that's lacking, coupled with this pressure to like show that you've arrived, you've done well, you can get the car. The truth is, you get the car, you can afford the insurance, but now wear and tear is a problem.
Fuel
is a problem. And also you hamper yourself when you want to then buy a property, because you've put all of your money into this car. So then you're At the point when you want to buy that property, you've got to take stock and go, do I downgrade this car to get the home loan? Or if you actually went, over indebted on that car, at some point you have to make that trade-off. And it's uncomfortable, I think, at that point to let go of the beautiful car. It's highly recommended that they start off small, rather start a good saving discipline, create buffers for themselves so that their financial journey is not one that's also stressful.
I wish you guys were there when I was starting out, having an insightful conversation about debt and young professionals. Let's take a quick break before we pick up with the mistakes that can lead to very bad big debt decisions.
Life feels different when you have a partner who helps you make confident, informed financial decisions. With an Investec private bank account, you get more than just an account. You get access to a dedicated private banker who collaborates with you to understand your financial goals and financial advisors so you can make informed, long-term decisions. Plus, enjoy access to competitive rates and rewards points that never expire. As you shape your future, partner with a bank that helps you do it wisely. Now that's private banking.
Welcome back to Everything Counts. Let's get right back into our conversation, talking young professionals and the decisions you make as you get into the working world, especially when it comes to credit and debt. Keshnie, can you talk us through the everyday mistakes young professionals make? And what are the bigger ones that we can make that can become a ball and chain to our finances?
So I think the one that's really important is having a monthly budget and managing your expenses so that you prioritize necessities over luxuries. It also gives you a good view of how much you have available to put into a loan or a car or a home loan. That's a key for me. One of the other things is when you're looking for a loan is to also look at what are some of the ancillary costs that you're going to incur, like insurance, for example, when you're buying a car. We covered the wear and tear. When you're buying a home, you've got the home loan insurance, but in addition, you're paying for water and lights that may not have been a responsibility before, transfer costs, all of that. Levies if you're in a sectional title complex, and those levies can be quite a lot. So it's important to look at what are those ancillary costs you're going to incur when you take on the loan. I think also in terms of the loan specifically is to look at what interest rates you're paying. Is it competitive? Have you shopped around? What is the total value of the loan that you're actually going to pay over the term of it? Because we look at the monthly installment, we think it's doable. But when you look at the total loan, the capital plus interest, it's a lot over a period of time. And here again, you can put some of the savings towards paying down those loans a little bit quicker if you are keen on creating wealth. If you want to start, building a portfolio of investment properties in the next 10 years, it becomes an important consideration to have that budget, to have the discipline to save, to have the discipline to plan and have those financial goals.
So you're saying you could be asking for 2,500 Rand, but end up paying 7 if you're not really checking how long the term of the loan is and how that is affected by the interest rates. So you still need to make that decision whether to save up that 7,000 Rand before making that purchase or actually getting into a better loan or negotiating for a better interest rate.
Absolutely. Absolutely. And we know that interest rate changes. So if you haven't factored that into your planning as well, you've got no buffer to absorb that interest rate change. And we know we've just come out of a rate hike cycle. I mean, we've had a few decreases, which we're all enjoying. But when it's on the upward trend, it can really strain what you're left with at the end of a month.
Yeah, because some people take the longest possible repayment term, in order to have that monthly repayment become a little bit lower. But that's not always a positive, right?
Correct. You need to understand everything that actually does make up the deal, including the small little details. For example, when you're buying a car and they include a balloon payment or what we sometimes refer to as a residual, that will lower your monthly installment. But you need to understand the actual implication of that and what it means for you, because sometimes people get a deal like that and they are shocked at the end of 6 or 7 years when they have to make this big lumpy payment because they didn't understand upfront what it meant. At that point, all that mattered is that I want to drive this car and I want it now at a lowest installment possible without actually understanding how the deal is structured.
Let's go through that about what makes a bad deal. What are the things to look out for, the red flags when they put the papers in front of you, you can tick off to say, okay, I don't think I'm getting the best deal here.
Firstly, banks are very competitive, or financial providers at large are very competitive in this market. So it's very important to have a negotiation hat on. So if you do get a deal and it's at Prime Plus, ask yourself, what is the market offering? What are other people getting, including your peers? So for example, if you are financing 200,000, the deal is structured in a way that you are only paying off the 100,000 capital over the 6 or 7 years. So you're only expected to pay the other 100,000 as a lump sum at the end of the loan term. So it's important then to understand, will I have this 100,000 at the end of the 6 years or 7 years? Because then if you don't, what happens is that you either have to refinance it or you have to take out or buy another car.
Keshnie, looking at that prime lending rate, the rate that the banks charge consumers for different types of loans, when the South African Reserve Bank tells us about interest rates, telling us that prime is at 10.25%. Some people do expect that's what is going to be on the contract and they never check, but that could be way more than 10.25% that you repay.
Absolutely. It all depends on how the bank sees you and your risk profile. You should shop around for the best rate. So based on your risk, you could get prime minus or prime plus, and it's important to then look at the fine print. It's also important to look at what penalties you're going to incur. If you're going to settle a vehicle or settle a home loan. Those are all long-term consequences of changing your mind or finding a bigger, beautiful house that you want to buy. And then these things become obstacles, on your path.
Let's go a little deeper then, looking at things like unsecured loans, store cards as well, especially what we see more recently, the buy now, pay later apps, all offered on the market, but can be problematic if not well managed.
I think there's a caution there around having too many unsecured loans. And just to reiterate, your unsecured loan, it's not secured by any asset. And what could happen in the long term is that taking out too much of that debt could hamper you buying the big car or the big home that you're looking for, because it does talk to your payment profile, your behavior, how you budget. And that is something banks look out for.
So when the bank looks at that, it's basically your report card to them and how you manage your finances, what you're paying off, what you've defaulted on. That's very key, especially when you say accumulating assets that you might want to get later in life, like a house. So how important is it to look at the buy now, pay later with more scrutiny?
It is very important to not just the buy now, pay later option, but it's very important to look at all forms of credit with a lot of scrutiny, understand what a missed payment means for you, understand what the impact that all of these has on your cash flows means for you in the longer term. Just now we were talking about what a bad deal looks like, and ultimately any deal that puts you in a position where you don't have enough on a month, 2 month to actually service any day-to-day expenses is a bad deal. So it is important to look at any form of credit that you're getting yourself into with a lot of scrutiny and do your own affordability assessment and ask yourself, can I still live comfortably? So I just think generally it's very important to look at credit overall and understand every implication that your actions have on your credits. But it's things like your payment profile that go into there. It's things like your utilization levels, because if you're using up a lot of unsecured and maxing out whatever limits that you have, then the banks look at you differently because you look like you're relying on credit to get by.
Stressed, yeah.
Yes.
Well, let me ask then the blunt question, Keshnie, on behalf of every young professional. Is there such a thing as good debt?
Yes, there is. Investing in your education is good debt. Buying a home is a good debt. We know that properties appreciate over time, so that's an investment. And if you start looking at creating a portfolio of properties for yourself, that is also a wealth creation mechanism. If you're interested in starting a small business, that is seen as good debt because it's an investment into a small business, into you being self-sufficient, and that business can grow over time.
So taking out debt to buy a good suit, not necessarily the best type of debt, right?
Nah. I think what you can take away from this is that if you're taking out debt to invest, then you can consider it as good debt. But if you're taking out debt to feed into expectations and just feed this lifestyle that people expect you to live, and there's a lot of peer pressure and you're giving into it, then that is definitely not good debt.
You accumulate this debt and you feel a bit stretched financially. You start getting calls about consolidating that debt. Is this a good thing to do? Or are you forever going to be looked at somebody that cannot handle their finances if you go that route?
With the debt consolidation, for the first pass, you should try and manage your debt in a way that limits your spend on luxuries.
So
downgrade if you have to, downgrade that beautiful car that you bought. Free up some money that helps you pay off your debt by yourself. It is very difficult, and I would say particularly for a young professional who consolidates debt or goes through debt review to come out of that and have access to credit. There's also misconceptions that you can still access credit while you in debt consolidation or debt review, which is not true. So there I would say tread with caution, get assistance from your bank or your banker.
And there's a lot of calls these days where people will call you offering to help you minimize your monthly repayments. So they tell you that they'll structure your payments in a way that you don't have to pay as much as you are currently paying. And sometimes people don't understand what this really means. But essentially what you're doing is that you're telling all financial providers that you are over indebted. And during that period, then you will not have access to debt. So you just have to understand what you're getting yourself into. And sometimes you have people who avoid calls or statements at the end of the month because people have been following up with them or they're reminding them that you have to pay an amount on your account. So you don't want to find yourself in that position. You don't want to be that person who's avoiding all landline calls because you have debt outstanding. And if you do find yourself in that position, take those calls and have those conversations, understand what you have to do to get yourself to a better position, because avoiding it won't help.
And causes just too much stress. Well, that's the foundation, understanding the problem of debt. Being over indebted isn't just a financial setback, it's also a future killer. Your credit record follows you, your decisions compound, and those early mistakes can delay the life you're trying to build. Thank you to Keshnie July, lending product owner at Investec, and Lehlogonolo Ramushu, a credit risk consultant at Investec. In part 2, we're shifting from the problem to the solution. How to make smarter choices, build wealth, and partner with Investec to create the financial future you deserve. I'm Motheo Khoaripe, and this is Everything Counts.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of the firm and should not be taken as advice or recommendations. Investec Private Banking, a division of Investec Bank Limited, a registered credit provider committed to the Code of Banking Practice as regulated by the National Financial Ombudsman.